what I'm going to do today is I want to spend a bit of time talking through how we answer this ratios question for a long question. So all the stuff we've looked at in terms of theory of understanding the ratios and working out simple examples, that's generally your short questions. And to be honest, it is kind of more common for this to appear in short questions than a long question, but it does come up. And if it does come up, this is generally how it looks. You're given, something here to compare, like an industry average. You're given information about the business, a decent bit of information that you might have to work things out yourself. And then you're asked to find a couple of ratios and then talk about it. So what I've done is I've just put the question here on the right side. That's actually the bottom of the question. I've just put the question there again because I have a bit of stuff to talk through. So this is just correcting the homework. First formula you're asked to get is the return on investment for BNUA. So return on investment formula is net profit divided by capital employed multiplied by 100 over 1 is percent. Net profit is 50 grand. Capital employed, that's not technically given as a term here, so we need to work that out. I don't know it. So capital employed, what is capital employed? If you look at the bottom of a balance sheet, you'll see the capital employed is the last figure. And what we get to add up capital employed, what we get to that point, is we have our long-term loans, ordinary share capital, and our retained earnings. These are all the basically long-term liabilities and equity. If you look at the bottom of the balance sheet, if you look in your notes at the bottom of the balance sheet, you'll see this here, that the capital employed is at the very bottom, and above that we have long-term loan, ordinary share capital, and retail earnings. You added those three up together, and then you get capital employed of 900 grand. So if I plug that in for capital employed, the missing figure that I don't know, 50 grand divided by 900 grand multiplied by 100 over 1, and the calculator gives you 5.555555. Obviously we need to do this to some kind of clean it up in some way, so I'd always do it to 2 decimal places. So let's turn to 5.56%. That's the first one. Second one, current ratio. What's the current ratio formula? Current assets is the current liabilities. Current assets are given to us here as 155 grand. Current liabilities are given to us as 85 grand over here. So current assets is the current liabilities. Divide here by the side and the right, and we'll find that it's 1.8 is to 1. So my current ratio is 1.8 is to 1. Again, current assets is the current liabilities, and dividing by the right side. So my asset test ratio is the third one they're asking us to get. I actually talked about dividing by, I'll get to it in a second. Hold that thought. So current assets, I can show it down here as well, same question. Current assets 155 grand minus my closing stock of 80,000 is to my current liabilities of 85,000. So if I take away closing stock, it gives me 75,000 on the left, 85,000 on the right. I had previously said before about dividing by the smaller one, so that you can find the simpler, 1 is to something. But I had forgotten that the way they mark it for leaving cert business here is to have the first ratio in relation to the second one. So it's not just about simplifying to have 1 is to 1.16 or something like that. They specifically want you to show it in relation to the second one. So current assets minus closing stock in relation to current liabilities. So it's the ratio, the 2 dots figure here. So because they want the first one to be shown as a ratio of the second one, divide by the second one. So you divide this by the second one here, 85,000 divided by 85,000. For the first one, 75,000 divided by 85,000. Your answer here is 0.88 is to 1. All I've done here is I've taken the figures they've given, current assets, they've given us closing stock, and they've given us current liabilities. Fill in the formula, divide by the right side. 0.88 is to 1. Last part for, well, the first part. Debt to equity ratio. So what is debt? What is equity? There's no specific indication as to what the numbers are here. But debt is my long-term loans. It's the debt. It's the money you owe, long-term debt. 300 grand. The equity is the ordinary share capital and retained earnings. So again, I had gone through this in our notes copy for our formula, what equity was and what debt was. So equity is our ordinary share capital here, and our retained earnings, 500 and 100 grand. So debt is 300,000, equity adds up here, 2 of them together add up to 600,000. Quite simply, 300,000 divided by 600,000. 600,000 divided by 600,000. I've just shown this here because you know obviously that this is half of 3 is half of 6. Ratio 0.5 is to 1. So I'm showing the first one in relation to the second one. Ratio for debt to equity 0.5 is to 1. So last part that they ask us to do here, this was our first part. You have to know the formulas first of all. So you actually have to know the formulas going into the exam. But once you know that, it's quite easy to get the marks because you know the figures are given. But the second one, they ask you to analyze the business, analyze the profitability and liquidity with reference to the industry average results shown in the box and make recommendations. So you have to analyze profitability, liquidity, compared to the industry results, which we see up here. This is industry average for that year, and then make recommendations as to what this company could do to maybe fix it. Profitability first. So analyze the profitability. Well, we just worked out return on investment, so let's talk about return on investment. It's the return on capital for the investor. So the first thing I've done is, because we haven't looked at this before, this is new, I didn't expect you to know too much on how to answer it, but I want you to take this down into your notes copy, this section here. Please don't write while I'm talking, please pay attention while I'm talking, and you can write it after. So profitability. So return on investment was the formula from profitability. Again, in our notes, I the 3 sections: profitability, liquidity, and our debt to equity, our gearing. I've those 3 kind of laid out with the first one here, profitability, including gross profit margin, net profit margin, and return on investment. So we've done return on investment. Let's talk about it. It's the return on capital for the investor. So I've explained what it is. The ROI, return on investment, for BNUA is 5.56%. Where did I get that? We worked it out up here. 5.56%. That's the return on investment. How does it compare to the industry average? That's the industry average for the ROI, return on investment, 11%. And what did we get for the BNUA, their company? 5.56. So it's practically half the average performance of companies in the same industry. Just add in there 11%. That's obviously not a good thing. So our return is 5.56%, whereas the industry average is 11%. So investors will expect this ratio to improve. They won't be happy. If everyone else in the industry is getting a return, on average of 11%, and you're only getting practically half that, you'd like it to improve. So they will expect it to improve, and to improve it, quite simply, you could just say they need to invest their resources more efficiently or increase profits. That's our return on investment. That's me explaining our profitability side of things. Liquidity, there was 2 ratios given. We had 2 ratios here for liquidity. We don't need to look at explaining this one because that's not liquidity nor profitability. It's our gearing, it's our final one. So liquidity, I have 2. I have current ratio and asset test ratio. So let's look at current ratio first. So the current ratio for our company was 1.82. This one, we worked it out. So it's 1.82 compared to the national or the industry average of 2.1, 2 is to 1, sorry. Again, the ideal here is about 2 is to 1. So BNUA Limited is 1.82 is to 1 for their current ratio. Just to explain that, BNUA has 1.8, so they have €0.82 available to pay for every €1 they owed. That's what this ratio means. For liquidity, it's how much cash you have. So the current ratio means here that they have €0.82 available for every €1 they owe. And this is a little below the industry average of 2 is to 1. And that's actually the recommended average as well of 2 is to 1. Obviously they're below that, so they'll be disappointed. You'd like to have more money available for every €1 you owe. So they'll be disappointed to be below the industry average. They will need to make more of an effort to pay off their short-term debts, and that's our recommendation. They need to pay off their short-term debts in order to improve their ratio. The asset test ratio, the second one, their BNUA's was 0.88 is to 1. Where am I getting that? Worked it out here. Our asset test ratio, 0.88 is to 1. So that's the figure here. Industry average, 1.2 is to 1. And the recommendation is 1 is to 1. Just to go through it, so we got 0.88 is to 1. So they have 88 cents available right now to pay for every €1 they owe. This is more or less the same as this, except we don't look at closing stock. Closing stock is stock that we need to sell in order to get money in the short term. So for asset test ratio, it's it's looking at how much money you have right now to pay off your debt, and they have only 88 cents available right now to pay for every €1 they owe. So obviously, if they owed millions, they'd only have 88% of the what they owe in the short term available to pay. So this falls below the industry average of 1.2:1 and the ideal ratio of 1:1. So obviously they're below that. They'd prefer to be higher. Bianua will be disappointed. So they will be disappointed. Disappointed, of course. I'm two S's. I'm just going to say making. I'm disappointed. It's one S. I'm a business teacher. Please don't go to me for English advice. So Bianua will be disappointed. I'm just saying here, making. They will have difficulty. They will have difficulty paying off their short-term debts. So basically, look, if you owe €1 and you only have 88 cents available, times that by a couple of million, and now you're in trouble. They don't have enough money to pay off their short-term debts. So they'll have difficulty paying off their short-term debts, and they could focus on selling off their closing stock to raise cash to pay off these debts. So if you think about it, let's say SuperValu, had a ratio of 0.88 cents to 1 for their asset test ratio. That means for every €1 SuperValu owed, they had 88 cents available. How could they improve it? Well, closing stock doesn't come into this ratio. We take it out. So what we could do is if we sell off this €80,000 worth of closing stock, we'll have a lot more money, a lot more cash available, and we could use that then to pay off debt. So they could focus on selling off their cash to raise enough money, well, basically to pay off their debt. Focus on selling their closing stock to raise cash to pay off debt. I'm going through this at 100 miles an hour. I do that because you also have the option to pause, rewind. If there's something that doesn't make sense, you can pause it, see where I'm getting the figure from, find it over here, and then watch the rest of it. It is quite quick, but to be honest, this question doesn't come up a whole lot. If you like this question, as in the long question, if you like it, you could do quite well in the Leaving Cert if this comes up. People who like this question generally can get quite a high mark. Why? Because if you know the formula, you will get full marks here. I mean, if you know what the formula is, barring a calculation mistake, as long as you know what you're doing, it's quite easy to get the answers. There's not a whole lot of work needed. Compared to 20 marks for a long question, could take you a long time. You could do this, 2 minutes each if you knew what you were doing. So you get this done much quicker. Yeah, so it's a good question for those who like it. The profitability and liquidity, my analysis may seem like there's a whole lot going on. You don't need to learn it off. All I've done is just said, okay, so this is what the ratio means. Return for capital for investors, money available to pay off short-term debts, money available to pay off short-term debts. So I've explained what they mean. I've said what the percent was, I've said it here, and I've said it here. So I've said what our answer was for that ratio. I've said what it means. And then I've compared it to the industry average. Industry average. And in some cases as well, you could also compare it to an ideal ratio. If it's below the ratio, you're obviously going to presume they're going to be disappointed, especially for these ones. They're going to be disappointed because they don't have enough money available or they're not getting a high enough return. Obviously, if they're disappointed, you can say that they're expected to, this to improve and give a reason. So for the return on investment, they need to, invest the resources more efficiently. They need to increase profits. For liquidity, they need to make more of an effort to pay off their short-term debts. They need to raise more cash. For asset test ratio, they need to focus on setting off closing stock to raise cash. But I could probably throw in a few different things there. There's no right or wrong. You're not, as obviously there's a right or wrong, but there's no one answer. There's multiple things you can say, and they're quite generous with their marks for something like this because a lot of people do not like this question because they don't like the idea that you have to understand it. They prefer just learning things off, not understanding it. If you like it, you can do quite well. That's all I'll say. Take this down into your notes copy, our liquidity section and our profitability section. So this is to be added to the notes. This is a detailed breakdown of answering a long question for this topic. I'm going to give you a few small questions now to do for this class this week as well. That's all.